The last thing I want to cover here are some pitfalls to avoid when investing in the NASDAQ 100 or really making any kind of long-term investment into funds. First of all, lump sum investing or putting all of your money into the market at once is generally a very bad idea. Imagine a scenario where you end up piling all of your money into the market at what ends up being the top, only to see a massive decline in value of your assets thereafter. And then, instead of being able to buy the dip, you're already 100% invested, leaving you with no idle cash on the sidelines. This is a very real possibility, and although it will likely recover eventually, it can be an extremely stressful situation. The solution to this is dollar cost averaging, which is actually what we discussed earlier and demonstrated by making consistent routine investments at regular intervals. On the other side of the coin, another pitfall to avoid here is overreacting to market volatility or big drops in the market. The stock market has these defined boom and bust cycles, but historically it has continued to generate positive returns over the long run. A lot of people make the mistake of panic selling when the market goes down, only to miss out on the gains that typically follow. Instead, if the market goes down, you should probably look at this as an opportunity to buy shares at a discount because your money can buy more shares with the same amount of dollars. The last pitfall here is ignoring the fees that are associated with investing, as this is really the silent killer of investment returns. As far as Invesco QQQ goes, the expense ratio is considered to be reasonably low at 0.20%. However, if you end up investing in other types of funds, ETFs, maybe even mutual funds, be sure to look at what the fees are before committing your money because they vary a lot from provider to provider.